Here is something most investors are getting completely wrong right now. The market just hit all-time highs. AI stocks are exploding, and while everyone is chasing the same 5 names they saw trending on social media, there are stocks sitting right in front of them with better numbers, better growth, and better valuations, completely ignored. If you miss these, you are not going to get another chance at these prices. I genuinely believe that. I spent weeks running through hundreds of companies to bring you this list. 5 stocks for May 2026. Not the most popular, not the most talked about. The ones where the actual data tells a story that most people are not paying attention to. If you are serious about building real wealth and not just following the crowd, hit that subscribe button right now, because this is the kind of research that separates real investors from people who just watch stock prices go up and wonder why they missed it. Here is what we are covering today. 5 stocks across AI infrastructure, advertising technology, social media, and memory. One of them is going to surprise you, and I am saving the most explosive opportunity for last. Let's get into it. Stock number 1, Nvidia, ticker NVDA. I know exactly what you are thinking. Nvidia again? The stock that already went up 1,000%? Are you serious? Yes. Completely serious, and here is why. Most people look at Nvidia and see a stock that has already run. What I see when I look at the actual numbers is something completely different. I see a company that is still in the early innings of a decades-long transformation. Nvidia just reported $215.9 billion in fiscal 2026 revenue. 3 years ago, that same company had $27 billion. That is an 8-fold increase in 3 years. Find me another company at this scale growing that fast. I will wait. But here is the part that shocks people when I show them. The valuation is actually reasonable right now. At 24.2 times forward earnings, Nvidia is trading well below its historical average. Its price-to-earnings to growth ratio sits at just 0.72. Anything below 1.0 signals undervaluation. You are getting one of the fastest growing companies in history at a discount to its growth rate. And the demand side is not slowing. OpenAI just signed a $38 billion contract to rent clusters of Nvidia's latest GPUs. Anthropic committed to $30 billion of compute capacity in a deal built around Nvidia's Grace Blackwell architecture. These are not small experiments, these are decade-long infrastructure commitments. Now, here is what concerns me. Nvidia's stock is not immune to sentiment shifts. If AI spending slows down even temporarily, this stock will feel it fast. The valuation assumes continued dominance. Any cracks in that story will be punished. But here is my takeaway. Nvidia is not a chip company. It is the operating system of the AI revolution. Every company building AI runs on Nvidia hardware. That is not changing in the next 5 years. At current prices, this is still a buy. Now, let's shift gears completely, because the next stock is one that most people have heard of, but almost nobody understands correctly. Stock number 2, Broadcom, ticker AVGO. If Nvidia is the face of AI, Broadcom is the hidden engine behind it. And based on the numbers I am looking at, Broadcom is actually going to outgrow Nvidia over the next 2 years. Most investors think of Broadcom as a networking company. That is the old story. Here is the new one. Broadcom builds custom AI chips specifically designed for individual hyperscalers. Google, Meta, Apple, these are not off-the-shelf products. They are multi-year engineering partnerships where Broadcom learns exactly how a company's AI models work and builds hardware optimized for exactly that workload. The result? A chip that outperforms a general-purpose GPU for specific tasks at a lower cost per computation. And once a hyperscaler commits to that architecture, the switching cost is enormous. You do not just swap out a chip, you rebuild your entire AI infrastructure from scratch. The numbers back this up. Broadcom's AI semiconductor division grew 106% year-over-year to $8.4 billion in a single quarter. Analysts project 35.6% compound annual revenue growth over the next 2 years. That is faster than Nvidia's projected 26.2%. CEO Hock Tan believes the custom AI chip division alone will generate over $100 billion in annual revenue by end of 2027. For a division that essentially did not exist 5 years ago, that is an extraordinary statement. Here is my concern with Broadcom. The stock carries a premium valuation. You are not buying this cheap. You are paying for a business that has earned its premium through consistent execution. If that execution slips even once, the stock will get hit hard. My takeaway: this is not a trade, this is a long-term position. If you believe the custom AI chip market is real and growing, which the data clearly shows it is, Broadcom is the single best way to own that thesis. Buy and hold. Drop a comment below right now. Which stock so far interests you more, Nvidia or Broadcom? I want to see where this community stands. Stock number 3, Micron Technology, ticker MU. This is my contrarian pick, and I genuinely believe this is the most undervalued stock on this entire list. Here is the problem with how most people think about Micron. They see the word memory and they immediately think commodity, cyclical, boring. Move on. That thinking is going to cost them a lot of money. Micron does not make the memory in your laptop. Micron makes high bandwidth memory, the specialized chips that sit directly on top of every AI processor in the world. Without this memory, Nvidia's GPUs cannot function. There is no workaround. There is no substitute. The entire AI revolution runs on this product. And Micron is the only American company making it at scale. Now look at these numbers and tell me the market is pricing this correctly. Micron's entire 2026 HBM supply is already sold out, including their next-generation product that is not even fully in production yet. Revenue guidance for next quarter is $18.7 billion. Earnings growth of 440% year-over-year. 440% earnings growth. And the stock trades at 9 times forward earnings. Comparable AI infrastructure companies trade at 25 to 30 times forward earnings. That gap between what Micron earns and what the market is giving it credit for is one of the clearest mispricings I have seen in years. When the market catches up to this story, the repricing is going to be fast and it is going to be large. Here is my honest concern. Micron operates in a cyclical industry. If AI spending slows and HBM demand softens, the numbers can reverse quickly. This is not a set-and-forget position. You need to watch the demand signals closely. But at current prices, the risk-reward is exceptional. This is a strong buy right now. If you are finding value in this breakdown, hit that like button right now. It takes 1 second, and it helps this research reach more people who need to see it. Let's keep going. Stock number 4, Meta Platforms, ticker METE. I wanted to give you one stock on this list that is not purely an AI infrastructure play, and Meta is the one. Here is how most people think about Meta: Facebook, Instagram, Reels, advertising, maybe the metaverse if they remember that chapter. Here is how I think about Meta. 4 billion monthly active users, the world's largest first-party data platform, an advertising engine that competitors cannot replicate, and now an AI layer being deployed across all of it at unprecedented speed. Meta is not a social media company anymore. It is an AI company that happens to own the world's most powerful distribution network. Their Llama AI models are being adopted faster than almost any other model in the industry. Their AI-powered ad targeting is already driving revenue growth that analysts keep underestimating quarter after quarter. And their infrastructure investments are starting to pay off in ways the market has not fully priced in yet. The numbers support the thesis. Shares of Meta currently look 21% undervalued against a fair value estimate of $850. The combination of 4 billion users, dominant advertising revenue, and accelerating AI deployment makes this one of the best risk-reward setups in the market right now. My concern: Meta is exposed to regulatory risk in Europe and increasingly in the United States. Any major regulatory action could hit the stock fast. It is a real risk, and you should size your position accordingly. My takeaway: at current prices, Meta is not just an advertising stock. It is an AI infrastructure play with 4 billion users attached. That combination is worth owning. Here's where it gets really interesting. Our last stock is the one most investors are completely ignoring, and I think that is a massive mistake. Stock number 5, The Trade Desk, ticker TTD. This is my highest conviction pick on this entire list, and I think most investors are making a serious mistake by overlooking it right now. Here is the story. The Trade Desk had an absolutely brutal 2025. The stock fell nearly 70%, and when a stock falls 70%, most people assume the business is broken. It is not. Wall Street analysts still project 18% revenue growth this year, 16% next year, and you can buy this company right now at just 17.5 times forward earnings. That is cheaper than most boring consumer staples companies with single-digit growth rates. Think about what that means. You are getting a company growing revenue at 18%, operating in one of the largest and fastest-growing markets on the planet, at a valuation that implies almost no growth at all. The market punished one bad quarter and walked away. The underlying business is completely intact. Here is why the Trade Desk is uniquely positioned. Digital advertising is moving from human-managed campaigns to AI-optimized ones. Every major advertiser on Earth is trying to make this transition, and the Trade Desk is the only independent platform doing this at scale. Every advertiser who does not want to be trapped inside Google's or Meta's ecosystem has exactly one serious alternative. That is the Trade Desk. That is not a small market. That is a multi-hundred-billion-dollar market with one dominant independent player trading at a deep discount. My concern: the Trade Desk's recovery depends on continued execution. One more bad quarter and the stock will get hit again. This requires conviction and patience. My takeaway: at 17.5 times forward earnings with 18% revenue growth, this is not a trade, this is a position. The smart move is to buy a core position now and add on any further weakness. Let me bring this all together for you. If I had to rank all 5 right now in terms of where I would put new money today, here is how I see it. Number 1 is Micron. The valuation gap between what this company earns and what the market gives it credit for is the clearest mispricing on this list. Number 2 is the Trade Desk. 18% growth at 17.5 times earnings is an anomaly that will not last. Number 3 is Broadcom. The custom chip story is real and the numbers prove it. Number 4 is Nvidia. Still the operating system of AI at a reasonable valuation. Number 5 is Meta. 4 billion users plus AI is a combination worth owning at any reasonable price. Here is the investing truth I want to leave you with. The best opportunities in markets almost never feel comfortable. Micron feels boring. The Trade Desk feels scary after a 70% drop. Broadcom feels expensive. That discomfort is where the opportunity lives. The crowd is always most comfortable buying what has already gone up. The investors who build real wealth are the ones who do the work before the crowd arrives. You just watched this entire video. You now know something most investors do not. Use it. Now I want to hear from you. Which of these 5 stocks are you most interested in? Drop it in the comments right now. And if someone in your life is trying to figure out where to put their money in May 2026, share this video with them. This is exactly the kind of research they need. Subscribe if you want this level of analysis every single week. No sponsors, no fluff, just the truth about where the smart money is moving. See you in the next one.